Here is the actual mechanism. When a stock goes ex-dividend, its price drops by roughly the dividend amount on that exact morning, and that drop is not you losing money. It is the market subtracting cash that already left the company's bank account and is now sitting in your account instead. Same total value, different form. That is the whole trick people think is happening, and it is not a trick at all. That answer is correct, and on its own, it will still point you at the wrong decision, because it does not tell you why a company hands you that cash in the first place, instead of keeping it and growing the stock price for you. That question, not the price drop, is the one that actually decides whether a dividend stock is doing you any good. We are answering both today, in order, with real numbers from real companies, sourced so you can check every figure yourself, because this audience does not take a return figure on faith, and neither should you. Start with where that drop comes from, because it is not a Wall Street convention someone invented. According to the Securities and Exchange Commission's own investor education site, when a company declares a dividend, it sets a record date, the day you have to be a registered owner to get paid, and the ex-dividend date sits right before it. Buy on or after the ex-dividend date and the seller gets that payment, not you. FINRA backs this with an actual rule, Rule 5330, which requires brokers to cut the price on any open limit order by the exact dollar amount of the dividend the moment a stock goes ex-dividend. That is not a suggestion. It is a regulatory requirement because the value really did leave the company. The stock is worth less for the same reason your checking account is worth less the day after you write a check. The money did not vanish. It moved. A real company makes this rule concrete faster than a hypothetical one would. Johnson & Johnson, ticker JNJ, announced on April 14, 2026, that its board approved a 3.1% dividend increase from $1.30 a share to $1.34 a share, marking the 64th consecutive year the company has raised its payout. The record date was May 26th. The payment date was June 9th. That is not marketing copy. That is a board of directors, on a specific calendar day, committing actual company cash to actual shareholders. And it happens on a rhythm predictable enough that you could set your watch to it. None of this is a private arrangement between the company and its biggest shareholders either. Every one of those dates gets filed publicly the same day the board votes, in a document called an 8K. And it is sitting on the Securities and Exchange Commission's own public filing system for anyone to read. You are not being told this dividend exists. You can go verify it yourself in about 90 seconds. Here's the part almost nobody walks through, the part that turns this from trivia into something you can use. There are 4 dates that matter, and only one of them determines whether you get paid. The declaration date is when the board announces the dividend, which is informational only. The ex-dividend date is the one that actually decides it. Own the shares before that date and you are entitled to the payment. Buy on or after it, and you are not. The record date, usually 1 business day after the ex-dividend date under current settlement rules, is when the company's books officially confirm who owned what. The payment date is simply when the cash lands. Call that the 4-date chain. And the only date you personally need to watch is the second one, the ex-dividend date, because it is the only one your own buying and selling can actually affect. Now, the number you can run on your own portfolio. Total return from a dividend stock breaks into 2 pieces you can add together. Your total return equals your price return plus the dividends you actually collect. That sounds obvious once it is said out loud, but most people mentally track only the first half. Watch the price dip on the ex-dividend date and feel like they lost ground when the second half of that equation just deposited cash that makes them whole. Run this on your own numbers instead of taking my word for it. If you want a spreadsheet that does this math automatically instead of doing it by hand every quarter, there is a free Dividend Snowball Calculator waiting in the description. It runs this exact reinvestment math on whatever amount you plug in. Where does that cash physically come from before it ever reaches your account? It comes out of the company's retained earnings, the accumulated profit a business has chosen not to spend. When a board declares a cash dividend, accounting rules require the company to immediately reduce both its retained earnings and its total assets by that amount, which is filed publicly. Johnson & Johnson's dividend declaration, along with virtually every other public company's, gets disclosed to the Securities and Exchange Commission. The cash sits on the balance sheet as an actual liability the moment it is declared, and it is paid out of real profit, not out of a hope. That is why the ex-dividend price adjustment happens automatically without anyone at the exchange manually typing in a new number. The company's assets genuinely shrank by that amount, so the market price reflecting those assets shrinks with it. In an efficient market, the instant the stock trades without the dividend attached. The ex-dividend mechanic gets a lot clearer with a number attached to it instead of a concept. Say you own 100 shares of Johnson & Johnson going into the ex-dividend date at a hypothetical price of $155 a share for a position worth $15,500. The company's quarterly dividend is $1.34 a share, so you are entitled to $134 in cash. On the morning the stock goes ex-dividend, the share price mechanically opens lower, in this illustration, to roughly $153.66, a drop of exactly $1.34. Your shares are now worth $15,366, but you also now have a claim on $134 in cash headed to your account. Add those together, and you are back at $15,500, the same number you started with, just split across two places instead of one. Nothing was created and nothing was destroyed on that morning. Ownership of value simply moved from the stock price into your cash balance. That is the entire ex-date illusion. And once you have run it with real numbers one time, you stop feeling like the price drop is a penalty. That covers the mechanics cleanly, but it still has not answered the earlier question. Why does a profitable company choose to send you that cash instead of simply keeping it and letting the share price climb on its own? This is the retained cash choice, and it is the one almost every beginner explainer skips. A company that reinvests $1 of profit only creates value for you if it can turn that dollar into something worth more than $1, a new factory, a better product line, an acquisition that pays for itself. A young, fast-growing company usually has plenty of those opportunities and keeps every dollar. A large, mature company, one that has already built out most of its factories and already dominates its category, frequently runs out of projects that clear that bar. At that point, retaining more cash inside the business does not make you richer. It just leaves idle money sitting on a balance sheet, earning less than you could earn putting it to work yourself. Sending it to you as a dividend is the company admitting, in effect, that you can currently do more with that dollar than it can. This is also why you almost never see a company still in its aggressive growth phase paying a meaningful dividend at all. Every spare dollar it has is already earmarked for expansion that management believes will outrun what a shareholder could do with a cash payment. The dividend only shows up once that math flips, once the company has more cash than it has good uses for. Recognizing which side of that line a business sits on tells you more about whether its dividend is sustainable than the yield number ever will. Coca-Cola is a clean second example of exactly that pattern. The company approved its 64th consecutive annual dividend increase in 2026, raising the quarterly payout from 51 cents to 53 cents a share. A company that is not chasing rapid factory expansion, it is a mature, cash-generating business choosing to return the bulk of what it earns. Procter & Gamble did the same thing that same year, raising its dividend for the 70th straight year from a base that had already stood for 136 consecutive years of uninterrupted payments, with the increase declared on April 14th, 2026. Record date, April 24th. Payment on or after May 15th. 3 companies, 3 separate boards, 3 separate announcements, and the same underlying logic every time. Mature, profitable businesses returning cash they cannot deploy more productively than you can. If you take the cash instead of reinvesting it yourself, here is what compounding on that cash actually looks like. Reinvest that $134 payment from the earlier example back into more shares at $153.66, and you pick up roughly 0.87 additional shares. That fraction alone looks small. Run the same process every quarter for years, with the dividend itself growing 3 or 4% annually the way Johnson & Johnson, Coca-Cola, and Procter & Gamble have all just demonstrated. And each of those quarterly payments is now buying you a slightly bigger share count, which then earns its own slightly bigger dividend the following quarter. That is the actual snowball, and it is exactly why tracking fractional shares by hand every 3 months gets old fast once a portfolio has more than 1 or 2 dividend payers in it. Before you go looking for the highest dividend you can find, run one more check, because this is where beginners get burned. A payout ratio measures how much of a company's actual earnings it is sending out as dividends, and a company paying out more than it earns, funding the dividend with new debt instead of profit, is not demonstrating strength, it is borrowing time. That is the payout ratio gauge, and it is the single fastest way to separate a durable dividend from one that gets cut. A company like Johnson & Johnson, raising its payout for 64 straight years, including through recessions, is telling you something concrete about the durability of its cash flow. A stock advertising an unusually high yield with no comparable track record is telling you the opposite, and the yield itself is often the tell, since a falling share price mechanically inflates a dividend yield even while the underlying business is in trouble. One more mechanical detail worth knowing before you file taxes on any of this. Not every dividend gets taxed the same way. A qualified dividend, one where you held the stock for more than 60 days during the 121-day window centered on the ex-dividend date, gets taxed at the lower capital gains rates, which for 2026 top out at 20% and can be 0% for single filers with taxable income under roughly $49,450 or under roughly $98,900 for a married couple filing jointly, according to the Internal Revenue Service's published thresholds. An ordinary, non-qualified dividend gets taxed as regular income instead, at whatever your normal bracket is, which for most people in this audience is a noticeably higher rate on the exact same dollar. That single 60-day rule is the difference between two very different tax bills on the exact same dollar amount of dividend, and almost nobody who owns dividend stocks has ever had it explained to them plainly. So here's the actual reframe, and it is the whole reason this video exists. The ex-dividend price drop is not what determines whether owning this stock made you money. What the company does with the profit it chose to keep, instead of the profit it paid out to you, is what determines that. A company retaining cash and reinvesting it at a high return is building you more value than the dividend check ever could. A company retaining cash and wasting it, or a company borrowing money just to keep a dividend streak alive, is quietly destroying value no matter how reliably that check shows up in your account. The price drop on the ex-dividend date was never the story. It was accounting doing its job correctly. The real story is upstream of that, inside the boardroom, in the decision about what to do with the dollar that was not sent to you. That is also why two companies can post the identical dividend yield on paper and be worth completely different amounts of trust. One of them is funding that payment from genuine, growing profit and handing you the overflow. The other is stretching to maintain a number it announced years ago, even as the business underneath it weakens. The yield alone cannot tell you which one you're looking at. The payout ratio and the trend in the company's own earnings behind it can. Pulling the whole mechanism back together, the 4-date chain tells you exactly which single date controls whether you get paid. The X-date illusion shows you why the price drop that morning is not a loss, just value changing form. The retained cash choice explains why a mature, profitable company sends you cash instead of keeping it, because it has run out of ways to turn that dollar into more than a dollar internally. And the payout ratio gauge gives you the one number that tells you whether a dividend is durable or borrowed. None of that is opinion. Every figure in it traces back to the SEC, FINRA, the IRS, or the company's own investor relations page, dated as of 2026. Before you go, 3 things worth putting in the comments. Which of these 4 dates had you genuinely confused before today? The ex-dividend date, the record date, or something else entirely? Have you ever sold a stock too early because you thought the ex-dividend price drop meant you had lost money on the position? And when you check a dividend stock's payout ratio for the first time this week, what number are you expecting to find? If you want the natural next step after this one, go watch the video on this channel walking through the best ETFs to actually live off dividends in America, because everything you just learned about how a single stock pays you is exactly what is happening underneath every fund in that video too, just spread across hundreds of companies at once instead of one.